Let's start with an observation. Between March and September of 2024, the same banks that spent a decade suppressing silver prices reversed their positions by 41,000 contracts. That's not speculation. That's documented data from the commitments of traders, reports filed with the CFTC every single week. And if you understand what that number represents in actual metal, roughly 205 million ounces, you begin to realize we're watching something that hasn't happened in this market since the early 2000s. The commercial banks aren't your friends. They never were. But they're also not stupid. When institutions managing trillions in derivative exposure execute a coordinated position shift of this magnitude, they're not doing it because they suddenly care about fair markets. They're repositioning ahead of something they see coming that retail investors don't. The question isn't whether silver is going higher. The question is what these banks know about the timing that prompted them to flip sides after years of fighting the exact opposite direction. I want to walk you through 3 specific data points that mainstream financial media won't connect for you because, frankly, they either don't understand commodity market mechanics or they're incentivized not to explain them. We're going to look at the actual position data. We're going to examine what happened in the physical market while these paper positions were changing. And then we're going to discuss why the timing of this reversal tells us more than the reversal itself. The first thing you need to understand is how the futures market actually works as a control mechanism. For decades, the COMEX silver market has operated with a fascinating imbalance. The commercial traders, primarily large banks, consistently hold short positions while speculators hold long positions. This isn't controversial. It's visible in every COTI report going back 40 years. The banks sell paper contracts they don't intend to deliver against. Speculators buy paper contracts they don't intend to take delivery of. And the price discovery happens in this derivative layer completely disconnected from physical supply and demand. What makes this significant is the banks win this game through position size. When you can sell unlimited paper contracts into a rising market, you create artificial supply that doesn't exist in the physical world. Silver tries to rally, the banks dump another 10,000 contracts onto the market in a coordinated smash, usually during low liquidity Asian trading hours, and the technical traders see the chart breakdown and sell with them. It's a beautiful system if you're a bank with unlimited capital and regulatory capture. It's devastating if you're a mining company trying to finance operations or a retail investor who does not understand you're not trading a commodity, you're trading a derivative of a derivative designed to suppress price. But here's where it gets interesting. Starting in March 2024, this decades-long pattern broke. The commercial net short position, which had been hovering around 65,000 contracts, began declining. Not gradually, aggressively. By September, it had dropped to 24,000 contracts. That's a reduction of 41,000 contracts in 6 months. To give you context, the commercial banks reduced their short exposure by 63% in half a year after maintaining extreme short positions since 2019. Now, some analysts looked at this data and celebrated, the banks are finally covering silver to the moon. But that analysis misses the more disturbing implication. These banks didn't suddenly develop a conscience. They didn't wake up and decide market manipulation was wrong. They covered their shorts because the risk-reward of maintaining those positions fundamentally changed. And the only thing that changes that calculation is certainty about future price direction. This cannot be overstated. When you're a major commercial bank holding billions in derivatives, you don't exit a profitable manipulation scheme because you feel like it. You exit because continuing that scheme became more expensive than abandoning it. Which means something changed in the underlying market that made suppressing silver prices untenable. The question is what? Let me show you what was happening in the physical market during this exact same time frame. While the banks were covering shorts in the paper market, global silver demand hit levels we haven't seen since the early 2000s tech boom. The Silver Institute's data shows industrial demand alone exceeded 600 million ounces in 2024. Solar panel manufacturing consumed 212 million ounces. Automotive applications took another 88 million. Electronics, another 74 million. And this is before we talk about investment demand, which spiked 23% year over year as both institutional and retail buyers started accumulating physical metal. What's remarkable about this is mine supply only increased by 2% during this period. We're not discovering massive new silver deposits. We're not seeing technological breakthroughs that make extraction significantly cheaper. The geological reality is that silver deposits are getting harder to access, grades are declining, and most silver comes as a byproduct of copper, lead, and zinc mining. When those primary metals become less profitable to extract, silver production drops, even if silver prices rise. It's not a responsive supply market. So you have demand increasing by double-digit percentages, supply barely moving, and the banks that spent a decade capping prices with paper derivatives suddenly backing away from that strategy. The supply-demand fundamentals were screaming shortage. And the same institutions that profited from ignoring those fundamentals started behaving like those fundamentals suddenly mattered. That's not a casual shift. That's a strategic repositioning. Now here's the piece that doesn't get discussed enough. And while all this was happening, the COMEX registered silver inventory, that's the metal actually available for delivery against futures contracts, dropped from 89 million ounces in January 2024 to 41 million ounces by October. That's a 54% decline in deliverable inventory in 10 months. And this is happening while open interest remained elevated, meaning the number of claims on each ounce of physical silver was increasing dramatically. Think about that dynamic for a second. The banks are reducing their short positions precisely when the ratio of paper claims to physical metal is expanding. If you were confident you could continue suppressing prices with paper, you'd maintain those shorts and profit from the inevitable sell-offs you could engineer. But if you thought there was even a 10% chance that a delivery squeeze could happen, where enough contract holders actually demand physical settlement, you'd cover immediately. Because a default on the COMEX would be a systemic event that makes the nickel crisis on the London Metal Exchange look like a rounding error. The pattern becomes clear when you overlay this data with what central banks were doing during the same period. Central bank silver purchases aren't reported with the same transparency as gold, but we have enough data points from national mints and bullion banks to know that sovereign accumulation accelerated significantly in 2024. China's state apparatus, through various entities, was a consistent buyer. Middle Eastern sovereign wealth funds increased precious metals allocations with emphasis on silver because the gold to silver ratio made it the more attractive value proposition. When central banks buy physical metal, they're not trading. They're removing supply from the market permanently. Those ounces go into vaults and don't come back out unless there's a genuine crisis. Every ounce that moves from commercial circulation to sovereign reserves is one less ounce available to satisfy industrial demand or settle futures contracts. And the commercial banks know this because they're often the intermediaries executing these purchases. They see the orders. They see the vault movements. They know what's leaving the available supply pool. Now let's talk about timing, because this is where the entire analysis comes together. The banks didn't just reduce their shorts randomly. They did it during a specific window when silver prices were range-bound between $22 and $28 an ounce. They had 6 months of relatively stable prices to unwind positions without triggering a massive short squeeze against themselves. That's not luck. That's planning. If you're a major bank and you've modeled out that silver is going to $40, $50, or higher based on supply constraints and monetary policy, you don't wait until it's already at $35 to cover your shorts. You cover during the calm period when retail traders are bored, when momentum is sideways, when you can exit without competing with a stampede. The fact that this covering happened during consolidation rather than during a rally tells you they were working on inside information or sophisticated modeling that retail investors don't have access to. What is significant is that the Federal Reserve's own balance sheet operations during this period created the exact monetary conditions that historically precede precious metals rallies. The Fed was still technically in quantitative tightening mode, but the reverse repo facility was draining. The Treasury General Account was fluctuating wildly, and the net liquidity impact was actually expansionary. The banks could see this in real time through their Fed primary dealer operations. They knew that despite the public narrative of fighting inflation, the practical effect of Fed operations was increasing dollar liquidity. And silver, more than almost any other asset, responds to real liquidity conditions rather than stated policy. You can have the Fed chair talking tough about rates while actual systemic liquidity expands, and silver will price in the liquidity, not the rhetoric. The banks understand this because they're the ones creating the liquidity through their lending operations and their role in the repo market. They saw liquidity expanding, they saw physical supply tightening, and they got out of the way. This is significant because the mainstream narrative during this entire period was that precious metals were dead money. The Fed is raising rates, real yields are positive, there's no inflation case for gold or silver. Every financial media outlet was repeating this script. Meanwhile, the actual smart money, the banks that supposedly agreed with that narrative, were doing the exact opposite of what that narrative implied they should do. They were covering shorts, and in some cases, even going net long. When there's a disconnect between what financial institutions say publicly and what they do with their own capital, you should always trust the capital allocation. Words are free. Position changes cost money. The banks weren't spending millions in transaction costs to unwind shorts because they were bored. They were repositioning because their internal models showed that maintaining those shorts had become a losing trade. Now, I want to address something that's going to come up in the comments. Some of you are going to say, but the banks can just reshort silver once it rallies. They'll make money on both sides. And yes, tactically that's possible. Banks can cover at $25 and reshort at $35 if they time it correctly. But that's not what the data suggests is happening here, because the commercial net short position hasn't rebounded. Even as silver pushed toward $30 in late 2024, the banks didn't reload massive short positions the way they had in every previous rally since 2011. That behavioral change is the smoking gun. In every rally from 2011 to 2020, the moment silver gained 15-20%, commercial shorts would expand dramatically, capping the move. It was clockwork. You could set your trading strategy around it. But in the 2024 rally, that didn't happen. The commercial net short actually stayed relatively flat even as prices climbed. Which means either the banks fundamentally changed their multi-decade playbook for no reason, or they changed it because the underlying market conditions made the old playbook unworkable. I know which explanation I find more credible, and it is not the one where massive financial institutions suddenly decided to leave money on the table out of the goodness of their hearts. What we've learned here is the bank position shift isn't just interesting market data. It's a signal about timing that retail investors should be paying attention to. When the institutions that spent years profiting from price suppression reverse course, they're not doing it randomly. They're responding to market conditions that make the old strategy untenable and the new strategy necessary. The physical supply deficit isn't a future concern. It's a current reality that's getting worse. Industrial demand isn't slowing down. Solar installations are accelerating globally because of climate policy mandates. Electric vehicle production is ramping up, and each EV uses significantly more silver than combustion engines. 5G infrastructure deployment continues. These aren't speculative demand sources. These are locked-in industrial needs with multi-year contracts and procurement schedules. Meanwhile, mine supply faces geological constraints that can't be solved with higher prices in the short term. It takes 7 to 10 years to bring a new mine online, even if you discover a deposit tomorrow. The marginal supply has to come from recycling or above-ground stocks, and both of those sources are limited. The COMEX inventory drawdown shows that above-ground stocks are already being consumed. Recycling can't make up the difference because silver industrial applications often consume the metal in non-recoverable ways. So you have structural deficit, declining available inventory, and the banks that used to suppress prices with unlimited paper supply stepping back from that strategy. The timing of their exit suggests they see the situation accelerating, not resolving. And when banks position ahead of a move this aggressively, they're usually early, but they're rarely wrong about direction. The question you need to ask yourself isn't whether silver is going higher. The question is whether you're going to position ahead of the institutions or chase after they've already moved. Because the interesting thing about the futures market is that when everyone finally figures out what's happening, the available supply at reasonable prices disappears almost instantly. You saw it in palladium in 2020. You saw it in nickel in 2022. You're watching the early stages of it in silver right now. The banks switched sides quietly because they didn't want attention. They covered during consolidation because they didn't want to compete with retail FOMO. They repositioned when the narrative was still bearish because that's when repositioning is cheap. And now they're sitting there, waiting for the market to catch up to what their models already showed them. What happens next depends on how quickly the physical deficit translates into price action. But the fact that the banks are already positioned tells you they expect that translation to happen on a timeline that made paying up to cover shorts worthwhile. These institutions don't operate on decades-long timelines for trading positions. They covered because they see the move happening soon enough that holding those shorts became dangerous. Watch the timing. Watch what they do, not what they say. And understand that when the smart money reverses a multi-decade position, they're not doing it for fun. They're doing it because the market fundamentals changed in a way that made the old strategy obsolete. Silver is telling you something right now. The banks heard it first. The question is whether you're listening.